Hello, scholars. My name is Joseph Ejike Oji, and the topic of our lecture today is the valuation of stocks and companies. Let me begin by sharing my page with you. I believe you can see this. Very good. I think you can see it. Now, common stocks. Common stocks are, a part of the ownership of a corporation. When you buy common stock, that means when you buy a common stock of the company, that means you are buying a part of the ownership. You are becoming one of the owners of the company that owns that stock. For example, when I buy the stock of Walmart, for example, that means I have become one of the owners of the company, Walmart. Now, common stocks are expected to provide a stream of cash flows. It is that stream of cash flows that will make me, those expected stream of cash flow that will make me to buy a stock of a company because I want to get a piece of the action. I want to make profit. So that is the cash flow that comes from buying common stocks. Now, the value of a common stock, which is the value of a company, means the present value of all the cash inflows that are expected to be received by an investor. So those cash inflows comes in terms of dividends and then capital gains. And you get the capital gains if the stock of the company increases in value. What do I mean by that? Suppose that your stock that you bought, let me use Yahoo Finance to illustrate that. Suppose that you bought, I bought a stock in a company called Visa. Symbol is V. Yeah. As of today, I'm going to open the Visa. Let me see what is slowing down my computer. So the symbol is V. Okay, it's here now. I see that. Today, Visa is trading at $228.06 per share. If I bought this share now, today, and by next year, if this stock is trading at $300, the difference between $300 and $228.10 becomes my capital gain, which is my profit. Even if the Visa didn't pay dividends, I can still sell the stock and make money. Make even more than the dividend. Most dividends are usually 50 cents per share, $1 per share. But the capital gain is even much more better. That is why some people still buy stocks from companies that doesn't pay dividends, so long as the value of the share keep going up. Anyway, I think you get the point. What we are trying to do in this lecture is to explain to you how to value stocks. For any investor that is holding a common stock for 1 year, for example, then in that case, the value of the stock will be the present value of both the expected cash dividends to be received in 1 year and the expected market price per share of that stock at the end of the year. So that is, we're buying it and trying to hold it for 1 year. So this is the formula we use for that the value of the common stock, PO, equals the dividends received in 1 year divided by 1 plus R, the power 1, where 1 represents 1 year, plus the capital gain, which is the expected market price of the stock at the end of the year, P1, divided by 1 plus R to the power 1, where with the R means that investors' required rate of return. Let's look at this example. Let's try this one example. This example says that assume that an investor is considering the purchase of stock A at the beginning of the year. The dividend at the end of the year is expected to be $1.50, and the market price by the end of the year is expected to be $40. If the investor's required rate of return is 15%, find the value of the stock. So to do that, let me write down these numbers. D1, which is the dividend, is $1.50. Okay. And then the market price, P1, market price at the end of the year is P1, which is $40. And then investor required rate of return, R, is 15%. Now, you can do this with a calculator. That is, I usually encourage my students to use Excel, because when you start working, especially if you're working for a company, a brokerage company, a brokerage firm, you're not going to start punching calculator. You'll be using a spreadsheet program like Excel. So let's go to Excel and put this information in and get our answers. Where is my Excel? Okay. So that's the first example that we have. I'm going to move this in a little bit. Okay. So now, D1 is $1.50. And P1, which is the price at the end of the year, first year, is $40. Okay. So I'm going to change this into dollars. So we can put the dollar sign right there. Okay. Rate of return is 15%, which is 0.15 when written in decimal form. So we can now apply this formula here. The value of the stock now becomes, I put something here, just to simplify this work. I'm going to put this part 1 plus R to the power 1. So I'm going to do equals, 1 plus, let me in this form, equals, before you do any computation, except put equal sign. So 1 plus R to the power 1 comes 1 minus, 1 plus, okay, the R is right here, which is 15% raised to the power 1. Yeah. All right. Let's give our enter key 1.15. So with this, now we are ready to apply this formula, which is the value of the stock in question. So the value of the common stock equals D1. Okay. I'm just going to put the parentheses to separate this part from this part. D1, which is the dividends, divided by 1 plus R to the power 1. We have it here already calculated. This, okay, close the parentheses. Then plus another parenthesis, P1, which is the price, divided by 1 plus R to the power 1, which we calculated to be 1.15. And then we press the enter key. That will give us the answer. So this can see is $36.09 is the value of the stock after 1 year. So the expected value of it, see, $36.09. Okay. So and you can see that I did the calculations here as well. This is a typo, it should be $36.09. Okay. Now, we lead us to the next stage. Let's look at the general common stock valuation model. Usually, because the common stock has no maturity date, then because people can hold their stock for many years, we can now use, because this doesn't have a maturity date, it is good to use a more general multi-period model. to value the stock, So that model, we call it the general common stock valuation model, which is written as follows. PO, of course, you know that PO represent, excuse me, yep. Okay. PO is the value of the common stock. Well, okay, take you to somewhere. Oh, got it. So where PO represent the value of the common stock is sum of DT1 plus R to the power T. Of course, you know that D is the dividend. R is the investors require rate of return, and T is the time period. It can be 1 year, 2 years, 3 years. Okay. There are three cases that we look at when we are trying to value stocks. The first one is the zero growth stock. Second one is for constant growth stock, and third one for non-constant or supernormal growth stock. This three, we can look at these three cases. Let's start with the first one, which is the zero growth stock. How to value a zero growth stock. So in the case of the zero growth stock, if the dividends, that means dividend tends to, infinity. So you can see that the value of the stock is sum of the dividends, so the dividends, TT divided by 1 plus R to the power T. When we simplified it by factoring zero growth, zero as the stock doesn't, the value of the stock doesn't grow. As you say, zero growth. So it's constant, basically. Well, not really constant, but it just doesn't grow. Yeah, so we have DT over R to say. So that's it. When you simplify this formula, you're going to get DT over R, where DT is the dividend for the given time period, and the R is the expected investors' expected rate of return during that period. Example here, say a company pays an annual dividend of $3 per share, expects no growth in future dividends. Yeah. Like I say, when we're talking about this, we're talking about zero growth. We are referring to dividends, not the stock, the dividends. So it doesn't expect to any growth in the dividends. Then and has the required rate of return of 12%. What should be the price of the common stock? Yeah. So price of that common stock. Now, if you get the answer for the price of that stock, then that is the estimate of the price of that stock. And then you have your answer. And when you look at that stock, if it's bigger than that price, that means the stock is overvalued. But if it's smaller than that price, that means it's undervalued. So you can buy it and keep the stock. It will grow. Eventually, investors will recognize the value and start buying the stock. That's when it starts rising, and you make money. So now look at this. This company does not expect any to increase their dividend. So what should be the value of the stock? This would be a simple computation, because you are working with only DT, which is dividends at a given price and at a given time, and then the investors' expected rate of return. So our DT, okay, is $3, which is how much you pay in dividends, and the expected rate of return is 12%. Okay, R is 12%, which is 0.12 when changed to the decimals. Again, we can go to our Excel and put this in to get our answers. For the zero growth, DT is dividends is $3. Rate of return is 12%, which is 0.12 when changed to decimal. Okay, I'm going to change this to dollar sign. So in that case, the value of the stock, the price now becomes DT over R, which is $3 divided by rate of return, and that gives us $25 per share. Now, we look at that, this is your estimate. And if you look at the stock of that company and it is trading at, say, $15 per share, that means it is undervalued. You can buy it and keep it because eventually the market will recognize that value and start buying it. It will jump, you know. Okay, that is case one. And let's look at case two. Okay, for case two is when they value the for a constant growth stock. In this case, the dividend grows at a constant level. Let's say 5%. The company is paying 5% dividend every time they declare dividend. So in that case, to value it, we use the Gordon growth model. So under this model, we assume that dividend grows at a constant rate of G every year. So, and this is the formula we use to find out the dividend for the next year or next quarter, since it grows at a constant rate of G. So the formula is PO, which is the value of the stock, equals D1, which is the expected dividend per share in 1 year, divided by R, which is the required rate of return, minus G, which is the growth rate of the dividends. Look at this question here. It says that as considered a common stock that paid $3 dividend per share at the end of last year, and it is expected to pay a cash dividend every year at the growth rate of 10%. Assume that the investor required rate of return is 12%. It's made a stock price. That means that is finding value of the stock. Now, first of all, because remember it says here, he paid $3 per share dividend in the last year and is expected to pay a cash dividend every year at the rate of 10%. Assume that the investor's required rate of return is 12%. What is the common stock price? Let's say the price in the next 1 year. This is or this year, because the one we have, the information we have is for about dividend is for the previous year. So I'm going to write down, in this case, let us find the dividend, compute dividend for the next year, the next dividend, which can be dividend this year. And then we use this formula here. But before we do that, let us write down the numbers. The dividend per share at the end of last year was $3. D-O, which is $3. Then, and the investors, the G part of it, which is the cash dividend growth rate every year is 10%. So G is 10%, which is 0.10. You can see that right here is 10%. And the investors' required rate of return is 12%. So R is 12%, which is 1.12 when written as a decimal. Let's put them in these numbers in Excel for the constant growth rate. Is okay. We have growth rate is 10%, which is 0.10 when changed to decimal, and rate of R is investor required rate of return is 12%. Okay. Then next thing we need is the dividends in the first year. Okay. Let's see, put it right here. First year dividends is $3. $3, right? I change this to dollar sign. So with this, I don't think we need this part. So let me just remove them. Okay. I'm gonna remove them. Or I can use them to simplify it. Okay. So because we need R minus G and 1 plus G, we get this part. So let's just do it, put them in. R minus G is equals R, which is this one here, minus that, because they are part of the formula. Okay, 0.02. And R plus G which is this one here, 1 plus, actually 1 plus G become equals 1 plus G, and G is the growth rate is 10%. So we have this one and this one as part of the two formulas we'll be using. That's why we get them here to simplify the work. So that means now the dividend in the first previous year was $3. That's DO. The next dividend will be to estimate if we use this formula, DT equals DO times 1 plus G raised to the power T. That means $3 times the DO, which is well, we have it already. DO times have 1 plus G. We have it here already. 1 plus G is 1.1. Clicked. Okay. Raised to the power T for 1 year. So that 1 year. So 1 year. That's this year, current year. So I'm going to close it twice so that we can have it will follow order of operation. See? And when we press the enter key, we get the estimate of the next dividend. With this, we can now apply this formula to find the value of the stock. Equal D1, which is this current dividend here, divided by R minus G. We have R minus G already here as 0.02. Click on that, and then press the enter key. See, $165 per share is the value of the stock. So again, we type our main values, the growth rate of dividends, required rate of return. And because R minus G and 1 plus G are part of the two formulas we'll be using, we figure them out first, R minus G and 1 plus G, and then apply the two formulas to get our value of the stock. Hope you are following and having fun. Okay, good. Now, let's return to our presentation, and I've given you an example with zero growth stock where the dividend does not grow. I've given you an example with constant growth stock when the dividend is growing. I look at the one that is most common among corporations, which is non-constant growth stock, whereby company pay this amount, maybe they might pay 5% of dividend this year. Next year, they pay 10%. The following year, they pay 1%. So it's non-constant. So firms typically go through life cycles. Don't know which part of their growth is faster. When their growth is faster than the economy, and then fall sharply sometimes. So in that case, the value of the stock during those supernormal growths can be found by taking the following step. First, compute the dividend during the period of supernormal growth and find their present value. Second, find the price of the stock at the end of the supernormal growth period and compute the present value of that price. Then third, add it to the dividend to the two figures, two present values that you obtained, and that will give you the value of the stock. Okay, let's try it here. Consider this a common stock whose dividends are expected to grow at a 25% rate for 2 years, after which the growth rate is expected to fall to 5%. The dividend paid last period was $2. The investor desired a 12% return. Find the value of the stock. So with this, you can see that you have two periods. There's a period of supernormal growth and a period when that growth wasn't supernormal. So there's this period of supernormal growth and the period when it wasn't supernormal. Let's do the first step, which is to compute the dividend during the supernormal growth period and then find the present value. So in that case, remember that dividend during the supernormal growth was $2. So we have that DO is $2. Okay. And that time it was growing at the rate of 25%. So G is 25%, which is 0.25. Then, so let us forget the dividends, because it says it grow at this rate for 2 years. So let's find the dividend for 2 years. So then find the present value. I'm going to put this on Excel. And remember that the investor desired 10%, so R is 0.12. So we can go put these values in Excel. Non-constant growth. So growth is G is 25%, 0.25. Okay. Remember that 1 plus G, 1 minute. Okay. 1 plus G is part of the formula. Remember to have these two formulas we'll be using for estimating the dividend and value of the stock of the company. So we have 1 plus G and 1 minus G. So let's figure them out. G prime in the meantime is the growth rate during the non-supernormal growth. Remember, that is the time when it falls to 5%. See? So I'm going to use G prime to present that time when the rate fell to 5%. So I'm going to use G prime, so for 5%. G prime, 5%. So 0.05. Okay. So remember that I say that this is the formula we use to estimate the next 2 dividends for 2 years. So we have 1 plus G components. So I'm going to add it here. Equals 1 plus G. 1 plus G. Our G is the growth rate of 25%. And then for the G prime, when it doesn't have a supernormal growth, we can have it at equals 1 plus G prime. This one here, just to put all these values in the cell so that to simplify the calculation. Okay. Now let's find the first dividends. Let me bring this down so you can see what we are doing here. So the dividend during the first one that it paid. Remember that the question says here that the expected growth of dividend is 25% for 2 years, but that the dividend paid last year was $2. So let's go and put DO as $2. $2. Then we have the number 1. Just put 1 here. Let's see. Just why did I put 1 here? Because of it's part of this 1 plus R. Okay. Now ready to work to estimate the dividend. Remember that it says during the supernormal growth, it takes 2 years. The rate was 2 years. So you're going to find a dividend for the first year, dividend for the second year. So that we go and put it here. D1 will be using this formula. Equal, have dividend paid last year was $2 times, put 2 parentheses because I'm going to want you to follow the order of operation. So 1 plus G raised to power T. 1 plus G, we have it here already. As a matter of fact, so no need for, well, just make it to make it follow order of operation. So 1 plus G raised to power T. We have 1 plus G here already. Click on that. Close the parentheses. Raised to the power for the first year. The cap key, I'm looking for the cap, okay. Raised to the power 1. Okay, and close the parentheses. Then now press the enter key. 2.5. Remember, this is dollar sign, so I'm gonna make it dollars. $2.50. This one is $2. Okay. Now for the second year, D2. D2 is 1 plus G. D2 is D1 times 1 plus G. So you have equals dividend the first year times 1 plus G. The 1 plus G. Now, because I'm applying the previous year with the previous year, we don't have to raise it to any power. But if we're using only this one here, then we have to raise it to the power 2. Okay. So that's why we have only 1 times 1 plus G, because I'm applying it with the dividend on the first year. Now, if you want to use, I'm going to show you what I mean by that. Just 1 minute. So 1 plus G is this one here. I'll close the parenthesis. Okay, $13. And you can see this, you can also see this here in my presentation, 3.125, which is 3.13. Okay. So now, either you do it this way, or you can use the first dividend. Like if I'm using this one now, let me show you on the side. If I'm using $2, then it's gonna be this times, then in that case, we have to raise to the power 2. 1 plus G, we have raised to the power 2. See, and then enter key. Give us the same thing. Let me move this. So you can, this is covering it. See, you give us the same answer. Now, but since we already calculated dividend for the first year, then and we're using it to calculate the dividend for the second year. That means we just simply use this formula without raising to the power 2. Okay. Now, investor rate of return required is 12%, 0.12. So we have calculated the dividend for the first year, dividend for the second year. Remember the question says, the requirement says, compute the dividend during the supernormal growth period and find their present value. So we did that just now. So now next is to find their present value. So to find the present value, we use this formula here. Okay, use the formula for the present value, which is the dividend divided by 1 plus required rate of return. And you can see it here. See, for the dividend for the first year and dividend for the second year. Okay, so that we have this. Oh, I didn't show it very well. So we compute it for, see, do it for the dividend for the first year and dividend for the second year. Okay, so their present value now becomes equals dividend for the first, the present value of the dividend becomes dividend for the first year equals D1, which is here, divided by, we have 1 plus R, which is 1 plus, R is the required rate of return of 12%. Okay, raised to the power 1. Close it. I'm gonna close it from here. I think it's good from here. 1, okay, 2. Best way to close it is to make it I think it's good. H1/1 plus this, okay? Then plus, repeat the same process for this. For the second dividend, which is D2 divided by, okay, 1 plus R, 1 plus, okay, R again, raised to the power, this time around for the second year is raised to the power 2. Okay, raised to the power 2, you can see right here, 2. Then close it. So we press the enter key to give us the result, $4.07. Okay, so we have done the first part, which is to compute the dividend during the supernormal growth period and find the present value. Next would be to compute dividends. Remember, this stock, after it grew for 25%, after it grew at the rate of 25% for 2 years, it went down to start to begin growing at the rate of 5%. So we're gonna compute the let me make sure you see this. Next thing is to compute the price at the end of the supernormal growth period. So the dividend, after doing that, we can now add the two dividends. So find the price at the end of the supernormal growth. Now, the supernormal growth is when it was growing at 55%, and that lasted for 2 years. So that means let us find the stock price at the end of the third year, which is when the growth rate fell to 5%. So to do that, we use D3, which is third year. Now, and that time we're gonna use the growth rate of 5%, which is when it went down to the when it is no longer growing. So let's say let me take you to the Excel. We'll calculate that. We have here. So D3 will now become equals D2, which is this one here. Okay. Times 1 plus G prime. See, this is 1 plus G prime right here. Click on that. And press the enter key. Now, next is to find the present value of that. See? And the present value of that would be, I can show you the formula in both places. The present value of that would be this one here. Is this one. But before we can find the present value, let's find the price of the stock and then find the present value of that price. So the price of that stock, when it is not growing at supernormal growth rates, becomes P2 over 1 plus R squared. Okay, equals P2, which is this one here. And so we have divided by okay, 1 plus R to the power 2. But this time, remember, this is the R is the required rate of return. So it's gonna be 1 plus, click on 1 plus R, okay, raised to the power 2. Okay, and that gives us 2.62, which you can also see here. You can also see here. Give me 1 minute. I think I made a mistake here. D3. I'm supposed to use D3, and I used the D2. So the price would be in 1 minute. You're gonna be equal P2. The D2 is gonna be D3. Have D3, which is the last dividend divided by R minus G prime. R is the required rate of return of 12% minus the G prime, which is this one here, G prime 0.05. Okay. Then after that, we can now find the present value, which is $46.88. Okay. Now we have the price for that stock. Remember, it says we get the dividends, then get the price of the stock. Now we find the present value of that price. So that's present value. We're gonna use the formula for the present value. That was what I did before. That's why I made that mistake. So the present value now becomes this one here. The formula is P2 over 1 plus out to the power 2. Okay, equals P2, which is the price here, divided by 1 plus 1 is right here. So 1 plus R to the power 2. 1 plus R to the power 2. And R is the investor required rate of return raised to the power 2. Then close the parentheses. And then press the enter key. give us $37.37, which is the present value of that. And you can see it in our presentation here. 37, around the 37, you know. Now, we add the two present values now to get our final answer for the value of the stock. So the value of that stock now becomes, excuse me, the value of that stock now becomes to add the two present. This is the first present value. I can see the second present value, which is the present value of the stock price. This is the present value of the dividends. So that's the value of the stock becomes the sum of the two present values, which is this one here plus this one, which means present value of dividend for the present value of the stock price. And that gives us the value of the stock, which is $42, $42.09. So this, we use this when the stock for non-constant growth stocks. Okay. So, and you can see I have the same answer here. And this leads us to the next thing, which is the what we call the expected rate of return on a common stock. Usually the formula we use is this one here. Some might have a slight modification of the formula to get this here. So the formula for computing the expected rate of return on common stock can be derived easily from these bundles, and that will give us this. So R becomes, which is the rate of return, D1 plus P1 minus PO divided by PO. We have P1 minus PO represent the capital gain, and PO represent the beginning price of the stock, and D1 represent the dividends. In other words, the expected rate of return of the common stock is the dividend yield plus the capital gains yield. Let's do an example of that. I say consider a stock that sells for $50 per share. Okay, it's sells for $50 per share, and the company is expected to pay. The company is expected to pay $3 cash dividends at the end of the year, and the stock market price at the end of the year is $55 a share. So let's find the rate of return, the stocks. So he said the company's stock sells for $50 per share. So have that D1, sorry, PO is $50. The beginning price is $50. And then the company pay a dividend of $3 per share. So that means D1 is $3 per share at the end of the year. And the stock market price at the end of the year is $55. So P1 is $55. $55. So with that, we can compute the rate of return on this stock. You can see right here. Let me show you where it is located. This, the price of the stock. Okay. We have the PO. We have P1 is $55. PO is $50. And D1 is $3. Now, if you look at the formula, let me write it down so we can be using it. The formula is R equals D1 plus P1 minus PO over PO. So we have it this form, and then we can calculate the required rate of return. It says compute the required rate of return. So we have it here, required rate of return return. Let me call it just return. It now becomes equals. We have it in, I start with parentheses, D1, which is $3. Okay, plus you have P1 minus PO. This one minus PO. Okay, close the parentheses, divided by the PO, which is 50. And that'll give us, let me see what I did wrong. So divided by P1. Okay, I didn't close the parentheses properly here. So have, let me do it again. So avoid this. So you have equal, D1 is, dividends plus, in parentheses, P1 minus PO. Okay, close it to Y so that it will balance on both sides. 2 parentheses at the beginning, 2 at the end, divided by the D1. Sorry, divided by P1. Sorry, PO. Like it was 16 return, which is 16%. Let's change it to percentage by just clicking on it and put the percent sign here. So the required rate of return is 16% for this stock. So 16%. And you can see that in our presentation here, 16%. Okay, which leads us to the constant growth model, which is the last one. So the constant growth, for constant growth in dividends, if there's a constant growth in dividend, then we can use this formula as our required rate of return. Yeah, copy it. So example here is, suppose that ABC company dividends per share was $4.50. So D1 is $4.50. And then expected growth, and it is expected to grow at a constant rate of 6%. R is 6%. And the current market price is $30. That means PO is $30. So you say find the expected rate of return. In that case, because it's a constant growth, we can use this our formula here. Let me put the formula here so we can use them. Look at it while we work on this. Yeah, the formula right here. Let me put it in this way. Make it fit. Okay, that's it. So now, in that case, we have that for constant growth, we have that our D1 is $4.50. Okay, I'm gonna make it a dollar sign. And then we have that our R is 6%, which is 0.06 when written as a decimal, 0.06. Next, we have PO is $30. In that case, the answer will now becomes the rate of return, expected return, or just the return. Return becomes, let's make sure I've seen this. Okay, good. Expected return becomes equal, plug in this formula. D1, which is D1, divided by PO, okay? Then plus the growth rate of 6%. This gives us change the percentage, 21%. So the expected return is 21% in this case. See? 21%. And you can also see this down in my presentation here, 21%. So I hope you enjoyed the lecture, and I will see you in my next lecture. Thank you for listening. Bye-bye.